All right, welcome to the July video in the series. So this slide, I'm not going to go over in too much detail. There's a prior video in the series that covers the different types of market edges there are. And I'm also not going to cover the edges in the series so far, but recently we've been on a seasonality kick, and today we're going to analyze something that is more traditional when people mention seasonality, and that is holidays. So historically, seasonality has referred to holidays, quarters, and time of the year. We actually start with one of the more difficult ones, which is day of the week, and then monthly seasonality. There's a lot of room in there for a lot of effects. Some people who like to trade more frequently tend to stick with day of the week and monthly seasonality, even going down to effects like what week is it in the month. There's a lot of phenomena around that I don't want to get into, but if you enjoy seasonality, I would recommend doing some examinations just around what week of the month is it, because you'll find some interesting consistent patterns there for various different instruments, especially US equities. So today we're going to talk about the Santa Claus rally, which is a Christmas / New Year type of seasonality effect. And holidays in general are what I recommend folks start with when it comes to seasonality, and that's just because they're easily explainable, they're trackable, and they're measurable. And if you're a member of the community, I actually have an entire list of methods and the order in which I recommend that you kind of start analyzing them. So whenever you pick an instrument that you're interested in trading and you're like, well, what should I test first? I actually have a list for you in this community where you can just kind of go down the list and analyze the holidays first and then the other things down that list. And part of the reason why I like holidays is because you can explain the effect. They're pretty consistent across a lot of instruments, and it's also just a way to get a quick, easy win. If you're like, well, I want to have a strategy for this instrument I'm looking at, and I want to find one relatively quickly, then you're probably going to find one around holidays faster than anything else. So the problem with holiday seasonality is that holidays tend to occur once a year. So in your backtest, you're not likely to have a statistically significant number of trades. So here is the one that we're going to be looking at today. This is the backtest for SPY. SPY was started in 1993, and so there's only been 32 years since then. And here you see that for the most part, markets tend to be, or at least US equities tend to be bullish near the end of the year, and there's many reasons for that. Part of it is just investors and people in general tend to be optimistic for the future. And so there's always that phrase of like, next year is going to be better. That is part of what drives it. But from a data standpoint, usually there's a lot more spending near the end of the year just because of that Christmas holiday and New Year holiday. So people are making New Year's resolutions. They're already looking to buy a new subscription. There's the Christmas holiday. There's a lot of gifts going around. A lot of numbers for sales and products just in general are higher at the end of the year. And so the Santa Claus rally holiday effect is very explainable, trackable, measurable, just in a lot of different avenues. So one solution I found for taking holiday-based effects is to look at multiple markets that have low correlation to each other as a whole, and then see if the effect is still there. So this is the Van Eck Gold Miners ETF, also known as GDX. And it's not gold specifically, it's gold miners. And I want to make that distinction clear. You can look up what that difference means if you're not sure, but you'll see that the effect is also present in the gold miners ETF basket. Now, of course, the GDX has only been around since 2007, but you see that you could split your position size between SPY and GDX. I actually recommend in the community that you split it across a third one, which I'll show later. But one way to mitigate that low statistical sample size is just say, hey, look, these instruments have low correlation to each other. Surely, if this effect exists in all of them, they're unlikely to be correlated. So for whatever reason, if we look at SPY last year, the effect was would have been a loser. But last year on GDX, you would have made money. And so it kind of balances out, and that's how I recommend it. And here you can see the correlation between GDX and SPY is 0.24. That's another thing in the community is I show this particular strategy along with a few variations on different markets, as well as the correlation, so that you can kind of piece together and say, okay, I want to trade this effect, and then I'm going to specifically pick these different instruments that have low correlation and then trade it that way. And again, here's the third one that I mentioned. This one on the right here, this is the Santa Claus rally in the Nifty 50. India doesn't celebrate Christmas, as far as I know, but they do celebrate some sort of end of year or New Year type of thing. And so, again, just because one market may not uphold the generally bullish effect that year, you're unlikely to see it across different world markets and different industries. And so that's one way you can diversify and overall come out ahead. So let's talk about the Santa Claus rally. Multiple reasons for the market to be bullish near the end of the year / before the new year. This is one that's actually well documented in Wikipedia. You can read about it. It's been around for decades, and it still makes money because, again, there's the numbers to support it. There's the general human behavior, like psychology aspects to support it. Just multiple reasons to support it going into the future. And this is just, again, another example of how seasonality and human behavior can be intertwined, and kind of flies into or rather is a counter argument to what a lot of people say, which is that edges degrade over time, which is not necessarily true. But again, I don't really want to go into that. If you want to understand market edges, please see that video earlier in the series about what exactly is a market edge. So the Santa Claus rally, in general, the way that I've developed it and the way I've traded it is you just take the first trading day after December 19th and enter long on the close, and then you exit on the close of the first trading day in the new year. Here again is the equity curve for SPY. Again, last year wasn't too great, but as we saw in the GDX, last year was a winner on the GDX chart. So you can hedge just by trading across multiple low correlated instruments. And the examples I give in the community for this one specifically are SPY, GDX, and the Nifty 50. And it's present in a few other instruments as well. And if you want to look at some European markets, you can also do that test on your own. But that is basically this month's strategy. I'm not going to cover all the holidays in this series. This is going to be the only holiday one I cover. If you're interested in looking up holiday effects, absolutely start there. It's again, it's a low-hanging fruit. You'll find a lot of consistent patterns around holidays for whatever instrument you're trying to trade. It's a great place to start.